Welcome back, everyone. This is Glenn Downing, Certified Financial Planner at CameronDowning, a registered investment advisory firm here in Miami, Florida. Today's topic is Social Security, and this video is the second in a two-part series. In part one, I covered the disability and retirement benefits available under Social Security. In this video, I'd like to give you a few thoughts about the solvency of the program. Now, a common question I'm asked in a financial planning arrangement is this: Glenn, should I plan on receiving Social Security? Will the money even be there for me? And I'll say yes, plan on it. Social Security is the third rail of politics, and it is my belief that it will always be there in some form or another. For those of you who've never lived in a city with a subway, the third rail is an electrified rail that runs along the tracks. There's a foot from the rail car that rides along the third rail, thus powering the car with electricity. Pretty much instant death if you touch it, hence the expression, third rail of politics. Throughout its history, Congress has always bought itself votes by increasing benefits, but haven't always raised revenue, i.e. taxes, in a commensurate fashion, thus creating deficits. Now, there is certainly a history of raised payroll tax rates, as I've noted above, and NRA has been raised. So what's being talked about now? Well, raising the NRA again. Currently, we're at 67. Another phased in, raised to age 70 wouldn't be a surprise. They could raise payroll taxes. That wouldn't necessarily get your congressman reelected. Or they could put a means test in, which changes the whole program from being social insurance to becoming a welfare benefit. Essentially, there'd be a means test. Even though you've paid in, you may not get any money out if you are earning too much, air quotes, and Congress uses the money to redistribute to those at the other end of the scale. Or they could privatize it. This is something Chile has done, and with considerable success. People have a choice of investment accounts, which include government bonds, into which they can allocate their funds. This puts the onus for providing for retirement squarely back on the taxpayer rather than the government. Whatever the program ends up is anyone's guess, but it is a very valuable benefit in retirement. Consider this: if I retire at 67 with a benefit of $2,000 a month, I expect to live to 90. And at 6%, the present value of this stream of income is nearly $300,000. If I lasted till 95, outlived my expectancy, then the present value of that benefit becomes $325,000. So any way you look at it, this is a very valuable benefit. Let's do one more calculation though. Say I came out of college at 22 and earned a steady $60,000 for the rest of my working life to age 67. 45 years, no raises. I would have deferred $37.20 each year. My employer would have matched it. What if instead I had invested both my half and my employer's half in my own brokerage account and earned a steady 6%? I would have accumulated a little more than $1.5 million. So there's a lot to be said for taking a close look at Chile's model. Once again, this has been Glenn Downing, Certified Financial Planner at CameronDowning. Please connect with us on LinkedIn, follow us on Facebook and Twitter, and visit our website, CameronDowning.com. There you'll find complete information on our pricing. You can even book an appointment to come see us right from the website. Feel free to call or email with any questions. It's always great to hear from you. Bye for now.